I've had the fallout and questions from people about the big run-up in property taxes in state after state across the country. And during the recent election cycle, the voters of North Dakota had a chance to eliminate property tax and chose not to. Other states trying to figure this out. What do you do to not force people out of their homes, particularly older residents maybe that are retired? I want to talk about that. And later, I've been getting lots and lots of questions about something that was a term no one ever asked me about: mortgage recasting. And so I'm going to give you the basics on what it would do for you, good and not so good. So I was stunned because I was sure, but I'm always wrong on this stuff, that when the voters of North Dakota stepped into the polling booth, that they would eliminate property taxes in the state, because what's happened over the last many years around the country is, with the run-up in home values, property taxes have gone up in tandem, and it's been really, really ugly for people making those payments. I mean, it's been tough stuff. But the voters in North Dakota were like, wait. We don't have a viable plan. My reading of it is that voters were like, we don't have a viable plan to replace the billions of dollars in taxes that underpin so much of state and local services if we have no idea how we're going to make up that money. This is a bad idea. But people all over the country are feeling the stress of property taxes going up and away. And it is really a budget buster for a lot of people on fixed income. So a number of ideas are being bandied about. A number of states have provisions where this all started in California with Prop 13 back in, if I remember right, 1979, which capped the growth in property taxes on someone once they were already in a home. What happens is you end up with this enormous disparity. Somebody who buys the next door home much later may be paying 10 times the property tax of someone who bought a home a long time ago. So it creates its own inequity right there. And so there have not been easy solutions to this with property tax, but there's clearly a problem. I'm a longtime volunteer and sponsor with Habitat for Humanity. And what's happened in a lot of urban cores where we have built, as volunteers, built habitat homes, is those areas have suddenly become hot and in, and the habitat homeowners get priced out of their own home because the property taxes become so large that they can't afford to stay anymore. And they have to sell this home that they worked so hard for, did sweat equity to be in, they pay that mortgage, and yet they can't stay because they can't afford the property taxes. So we need a different process for this. We need a different way of doing so that doesn't create enormous inequity between people who come in later in a neighborhood and people that were early. Because if you just do a straight cap, you end up with that great disparity. And it's not at all unusual that a longtime resident in a neighborhood in states that do have the caps end up paying a 10th or 15th of the property tax of somebody new in the neighborhood. That's kind of crazy, right? So we need to come up with solutions. And the one that I gave a couple of years ago that generated a number of Clark stinks is the idea of a big state, small state compromise, that people would have their property taxes adjusted that were longtime residents, but that they would only absorb half of the increase in value over the years that they lived there in terms of property tax increases. Just my idea that people didn't like. I'd love, when you post your Clark Stinks about this problem, to offer up solutions, because this is one I don't have a magic answer to. I can just tell you what we're doing right now, pricing people out of their homes simply with what the tax bill becomes is wrong. Coming up ahead, I got to talk about something that has been a conundrum for people. We've got a big slice of homeowners with mortgages that are in mortgage lock. You're in a home that you bought through the cycle of the artificially manipulated ultra-low mortgage rates that we had after the banking scandals. And you're in a loan that the luckiest among us, you have a rate that starts with a 1, a more common a 2, 3, or 4. And today the interest rates are 7 plus or minus. And so the burden, the carry cost of those loans is so high and way outstrips current inflation. So you're talking about a huge premium over the nation's inflation rate at 2 point whatever now. So let's say you're paying 7%, and you get, you're lucky enough to get a big end of the year bonus from work. So something that became a thing a year ago is a term people hadn't talked about to me in forever. It's called a mortgage recast. It's not a refi, it's a recast. So we're still stuck at these higher rates, and the payments may be causing people to wheeze. And so what a recast does, and most loans permit it, not all loans, you take that end of year bonus, or if you unfortunately lose a loved one and you get an inheritance, and you throw it at the balance of that mortgage. And when you put that against the balance, they recast the mortgage, keeping it the same length of term. So let's say you have 28 years left. You stay in a 28-year loan, but you now have a lower balance. So they recalculate it or recast that for the remaining 28 years, your mortgage payment is now lower because it's on a lower balance. So you're not shortening the length of your loan. You're still going to pay the ugly current interest rate, but you have less obligation every month. So there are people who maybe work in sales, or the company they work for had a great year and you get this bonus, or you have the loss of the loved one, or you win a lottery, or who knows what, and you take that money and you create more breathing space every month in your mortgage. So that's what a recast does. My preference, if you're able right now to handle your mortgage payment, you're able to do it, and you get that bonus, you throw it at the principal of your loan all in a lump sum. So you do a principal prepayment. What that does is your mortgage balance goes down, your monthly payment stays the same, but you end up paying far less interest, and your loan is done far sooner because you prepaid a big part of the principal. And then moving forward, yeah, you're still making the same payment, but much more of every payment is now going towards principal instead of interest. So the two scenarios: one, you're wheezing from your monthly payment. See if you can do the recast. But otherwise, if you're carrying current market rate interest about 7%, prepay, because your return on your money is a 7% guaranteed return, which is great. By the way, make sure your lender doesn't cheat you like some banks will try to do, and they treat it as you prepaying monthly payments instead of a prepayment of principal. Make sure that you check online that they applied it as a prepayment of principal. If the lender is trying to cheat you, you immediately file a complaint at consumerfinance.gov before you even make the first phone call to the bank that's cheating you.